Hi friends, welcome to Enoch's MBA. Today we are going to study meaning and basic concepts of accounting. Topic of Chapter 1, Introduction to Accounting, subject Accounting for Managers. After watching this video, you will be able to know the meaning and definition of accounting, to know the different characteristics of accounting, to understand the objectives of accounting, to understand the scope or branches of accounting, and to know the systems of accounting. Starting with the meaning of accounting. Accounting is a service function which provides financial information to the interested parties inside and outside the organization for their effective decision making. Hence, the primary role of accounting information is to provide useful and reliable information for decision-making purposes. Accounting is a systematic process of identifying, measuring, recording, classifying, summarizing, interpreting, communicating the financial information to the users. It shows the profit earned or loss incurred during the accounting period, value and nature of assets, liabilities and owner's equity, that is capital. Usually, accounting is understood as the language of business. However, a business may have a lot of aspects which may not be of financial nature. As such, a better way to understand accounting could be to call it the language of financial decisions. The better the understanding of the language, the better is the management of financial aspects of business. Accounting is an art and science of providing meaningful information about financial activities of the companies as a tool for management. This is used by a business for maintaining financial records on cash basis or accrual basis. Definitions of accounting. According to American Accounting Association, accounting can be defined as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. According to American Institute of Certified Public Accountants, accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are, in part at least, of a financial character and interpreting the results thereof. According to Smith and Ashburn, accounting is the science of recording and classifying business transactions and events primarily of a financial character and the art of making significant summaries, analysis and interpretation of those transactions and events and communicating the results to the persons who must make decisions or form judgment. Characteristics of accounting. The above definitions of accounting bring to light the following characteristics of accounting. First, identification of financial transactions and events. Accounting records only those transactions and events which can be measured in terms of money. This involves identifying transactions and events that are part of economic activity. For example, purchase of raw material or sales of finished goods by a firm. Such transactions are identified with the help of bills and receipts as evidence of the transactions. Second characteristics is measuring the identified transactions. Accounting measures the transactions and events in terms of a common measurement unit, that is, the currency of a country. In other words, we can say financial transactions and events are measured in terms of money. If a transaction has no financial character, then it will not be measured in terms of money and will not be recorded. For example, suppose you are a star performer in an organization. Your health, your energy is of great use to the business. But can you quantify your health value? Obviously not. Similarly, quarrel between you and your superior or bad working conditions for workers, etc. are facts that affect earning of the business, but they are not be recorded in the books because they do not have financial character or cannot be measured in terms of money. Thus, only those transactions and events which are of financial character will be recorded. Recording. Accounting is an art of recording business transactions. In the books of accounts, recording is the process of recording business transactions of financial character in the books of original entry, that is journal. This book is further subdivided into subsidiary books such as cash journal, or cash book for recording cash transactions, purchases journal, or purchases books for recording credit purchases of goods, or sales journal, or sales book for recording credit sales, etc. Classifying. Classifying is the process of grouping transactions or entries of one nature at one place. The transactions recorded in the journal or the subsidiary books are classified or posted to the main book of account known as the ledger. This book contains individual account heads under which all financial transactions of a similar nature are collected. For example, in Patel and Sons account in the ledger, all business transactions related to Patel and Sons are posted, so that what is ultimately due to Patel and Sons or due from Patel and Sons can be ascertained. Summarizing. This involves presenting the classified data in a manner which is understandable and useful for internal as well as external users of accounting statement. This process leads to the preparation of the following statement: trial balance, balance sheet, trading profit and loss account, all these statements are collectively known as financial accounts or financial statements. Next is analysis and interpretation. This is the most important function of accounting. A distinction is necessary to be made between the two terms analysis and interpretation. Analysis refers to methodical classification of data. If unconnected data are grouped together, understanding is not possible. All assets belonging to current assets are to be grouped together. Similarly, all current liabilities. If current assets and current liabilities are mixed together, data would be confusing. Interpretation means drawing conclusions from the data and explaining the conclusions in a simple language, easy to understand, and plan further course of action. Analysis and interpretation are complementary to each other. Interpretation is not possible without analysis, and analysis is of no use unless followed by interpretation. Communicating. Finally, the communicating function involves communicating the financial data, that is, financial statements, to its users. The accounting information must be provided in time and presented to the users so that Appropriate decisions may be taken at the right time. Objectives of accounting. The purpose for which the accounts are prepared. So following are the objectives of accounting. First is maintaining accounting records. The objectives of accounting is to record financial transactions and events of the organizations in the books of accounts in a systematic manner following the principles of accountancy. The next objective of accountancy is to determine the net results of transactions for a period. In other words, to determine whether during the accounting period the firm has earned a profit or incurred a loss. For this purpose, a statement called income statement or the trading and profit and loss account is prepared. Revenues resulting from the transactions of the period are recorded in the credit and expenses in the debit. The difference between the two sides is either profit or loss. Third is determining financial position. Accounting is to determine financial position of the business over a period of time. It is known from the income statement, that is, profit and loss account and balance sheet. Fourth objective is facilitating management. The management often requires financial information for decision making, effective control, budgeting and forecasting. Accounting provides financial information to assist the management in discharging this function. Fifth is providing accounting information to users. Accounting is to provide accounting information to users, both internal as well as external. Sixth is protecting business assets. Accounting is to have records of the assets owned by the business, which enables the management to protect and control them. Scope or branches of accounting. With the changing time, many new branches of accounting have emerged to meet the changed requirements. First is financial accounting. Financial accounting is the original form of accounting. It is mainly limited to the preparation of financial statements, that is, profit and loss account and balance sheet. Here, the preparation is made on historical basis, that is, after the happening of the event. All the persons who deal with the joint stock company want to know information about the financial health of the company. Profit and loss account provides information how the business has been conducted and final position about the profit or loss of the firm for a specific period. Balance sheet shows the financial position of the firm on a particular date. Next is cost accounting. Cost accounting has developed on account of the limitations of the financial accounting. Cost accounting is basically concerned with the estimation of costs in advance and their subsequent details analysis for the purpose of control. Management is interested to know the cost of the different products they make for the purpose of determining the price. Secondly, management has to take suitable decisions when they receive a special order at a lower price than the current market price for acceptance or rejection. When sources are scarce, everyone is interested to use the resources and manufacture that product in priority, which gives them more profit than other products. Cost accounting helps the management in achieving the profits they plan to achieve. Next is management accounting. Management accounting is the most recently developed branch of accounting. Management accounting is accounting for the management. Management wants information to discharge its functions in forecasting, budgeting, cost control, and strategy formation. Management accounting is a branch of accounting which furnishes useful data to the management in carrying out the various functions such as planning, decision making, and controlling the activities of the business enterprise. Accounting information is presented in an easy and ready to understand manner to the management. Here, the emphasis is on application of accounting techniques in planning and controlling the activities of the business enterprise and assisting the management in decision making. Systems of accounting. According to first type of classification, There are two systems of accounting for recording transactions: single entry system and double entry system. Single entry system sounds economical, but it is really costly. In fact, it is rather a lack of system. This system is adopted where the business is run on cash basis only. It is not a scientific system, and final accounts cannot be easily prepared on the basis of this system. Small businesses and organizations that do not require ascertainment of profit follows this system. Double entry system. The only real system is the double entry system. Double entry system recognizes the fundamental factor that every transaction is double-sided affair. According to this system, for every debit, there is a corresponding credit. For example, at the time of cash purchases, goods are received and in return, cash is paid. In the transaction, two aspects are involved, that is, receiving goods and paying cash. And under the double entry system, both these aspects are recorded. One part, that is, the receipt of goods, is debited, and the second part, that is, payment of cash, is credited. This system is universally followed in accounting. On the basis of this system, accuracy of accounting can be maintained and arithmetical correctness can easily be established. Financial statements, that is, profit and loss account and balance sheet, are easily prepared following the double entry system of accounting. According to another type of classification, again there can be two systems of accounting: cash system and mercantile system. Cash system is used where only cash transactions take place and the objective of the concern is not to make profit. In this system of accounting, entries are made only when cash is received, and no entry is made when receipt or payment is due. In case of club, library, educational institute, religious trust, etc., the objective of the concern is not to make profits. Only cash book is kept under this system. Some professionals like doctors, lawyers, and chartered accountants follow this system of accounting. Mercantile system of accounting. In this system of accounting, accounting entries are made when payment or receipt is merely due. It is not necessary that the actual receipt of payment has to take place. For instance, when service is received and actual payment is not made and books of account are to be closed for the year end, payment due is recognized and recorded for the service received. To illustrate, repairs have been made for machinery, bill is received but not paid. Books of accounts are to be closed as the year has come to an end. Payment due for the services received is recorded before the books are closed. In other words, repairs, though not paid, are recognized as expense and liability is created. Even if the bill is not received, repairs are estimated and the relative amount is provided as expense. Similarly, when sales is made and sales proceeds are not received, amount due on sale is recorded as an asset and income is recognized. The idea is to record all the transactions as if they are completed in all aspects. The objective of this system is to ascertain the correct profit position of the firm. Thanks for watching. If you like this video, please hit the like button. If you want to see more videos, hit the subscribe button. If you have something to say, please leave a comment. If you want to read this chapter, please log on to www.enotsmba.com. Thank you.